Hi, this is a video, the second video in a series of two that looks at an example question on corporation tax. And here is the example, fashion house, and it gave us the profit before tax, and we looked at adjusting their accounting profit in the last video for the items which weren't allowable for corporation tax. And we went through the question. I'm just opening it up here in case people haven't seen it all, and that's the end of it there. So based on all that detail, you were asked to calculate the corporation tax liability, and in the last video we went through the case 1 working, the case 1 profits working, to work out the tax adjusted profits. So that gives the trading profits, and we started with the profit before tax, added back took away other income, and then added back any expenses which weren't allowable as deductions for tax, and as well as that we did the capital allowances, and we ended up with case 1 profits of 358,550, and they come up to the corporation tax computation. And the corporation tax computation always looks something like this, and we even have a pro forma here of the corporation tax computation, what it looks like. So they always start with the Schedule D, Case 1, 3, 4, 5 income, add chargeable gains to that to get profits, and deduct charges if any. And then that gets taxed. And the only deductions really are any losses, current year losses that are claimed on a value basis against the non-trading income and chargeable gains. If there is dirt deducted, and preliminary tax paid. So we'll go back to the question. So here's the question. We've adjusted the profit before tax, the accounting profit, so that it's now 358, whatever it was, 550, and now that's what goes in as our case 1 trading profits. Then we look at the other income that was included in this. So the other income, we had rental income and some rental expenses throughout, but the other income is down here. Dividend from Irish resident company is ignored. It's franked invest income. It's not taxed under corporation tax. And gain on disposal of building, that's a chargeable gain. And for our purposes, you're going to be told what the chargeable gain is. So we'll assume this is what the chargeable gain is, 95,750. And that gets regrossed, so it's just 95,750 by 0.33 divided by 0.125, and that'll give us what should go in, or what we put in as a regrossed chargeable gain, and that works out at 252,780, and they'll pay corporation tax of 12.5% on that, and that'll work out at tax of $31,598, which is what someone would have paid. 95,750 by 0.33 works out at 31,597.5, which is the same, 31,598. So really, because companies pay tax at 12.5% on trading profits and chargeable gains, we have to just adjust that up, the chargeable gain. It's called regrossing it up. Next, we look at the other types of income. So I'm back to here. So we've done the two incomes that are in other income. A bit confusing, which is a bit annoying, but anyway, in the rent expense, rent and rates, which was here, there was rental income of 120,000, and we adjusted for that in the tax adjusted profit work, and we deducted that 120,000. Go back to our working. We deduct other income, and we deducted rent received. That's case 5 income, it's not trading income. That's why we took it away the same way as we took any other income that's not trading away. So now we will be showing for our rental profits here. We're going to have another working to do here, unfortunately. So I'll just come down to this and we'll call this. So this is going to be our case 5. And it's our income less any rental expenses. So the income was 120,000, rent received 120, and any rental expenses, and we'd have seen them perhaps in the detail in the notes, and there aren't that many in this question. There's nothing here, we didn't add anything back. If there were, we'd have added anything back to do with rental expenses, but there's nothing there. So the only time we see anything to do with rental, legal fees, and just purchase the rental property, but that's not a deductible expense. Let's go to interest, paid on money borrowed to buy rental property. So that's an expense, interest expense is allowable, and it was 50,000. So there is a restriction of 25%. You're only allowed 75% of the interest if it's residential, but this property that was let out was a shop, subsequently allowed, so it's a shop for commercial use, so we don't have the restriction. So the rental expenses or the interest of 50,000, and they were the only expenses. And so that's our case 5 profits of 70,000, and that's what gets brought up to here, to the corporation tax computation, and there was no case 3 and no case 4. So the total income then 428,580. We've done the chargeable gains, so the total taxable profits are the total income plus the gross chargeable gain to give us that, and then that gets taxed. The trading income is the case 1, so both the trading income and the chargeable gains get taxed at 12.5%. so you could show them separate if you wanted, but or show them together, but I think it's easier with 2 lines. And the passive income is the case 3, 4 and 5, so we've only one of them, which is 70,000. And just a quick check, that adds up to 681,330, which is what the total is here. And I multiply those together. That's how much tax is payable. And if the company paid any preliminary tax, or if it had suffered dirt, which it hasn't, on deposit interest received net of dirt, or if there was a current year loss to be used against reducing the tax on these guys, well then this tax, we could less deductions here, but there are none of those things. There was no preliminary tax paid, it didn't tell us anything, there was no dirt, and there was no current year loss anywhere in the question. So that's the end of the corporation tax computation. So that's the corporation tax payable, 93,916, and that's the end of that question. So I hope that's useful. Ask me in class if you have any questions.